Let us now look at the most important words in Article 4.1. And these kind of, if may not be an understatement to say that these are also some of the most important words from a treaty perspective, which is liable to tax therein. Article 4.1 tells you that a person shall be considered as a resident only when he is liable to tax in a contracting state. So what does this expression liable to tax therein means? The liable to tax expression means that it is only a person who is liable to tax under contracting state which are covered for the purpose of claiming a benefit under the treaty. So if you look at the India-USA treaty, if a person wants to claim the benefit of India-USA treaty, he has to prove that he is either a resident of India or a resident of USA. And to do that, he has to show that he is liable to tax under Indian laws or under the US laws. This has also been confirmed by the Supreme Court in Azadi Bachao case. Now, when we say liable to tax, what is the meaning of tax? Does tax means the income tax, or what kind of tax is covered here? Tax for the purpose of this article means one of the taxes which are covered in Article 2. Now we have discussed this aspect in detail as to what is the meaning of tax in Article 2, but in order to claim the benefit of treaty, you should be subjected to a tax which is covered in Article 2. If you are subjected to a tax in USA, which is not covered in Article 2 of the India-US treaty, then you will not be construed as liable to tax in USA. The tax has to be a tax which is covered in Article 2. Therein, what's the meaning of this word therein? Therein implies that the liability to tax should be in the state in USA for which you want to claim to be a resident. If you are liable to tax in UK, right, then you cannot say that I am liable to tax in US. Therein would simply mean the tax liability should be in the state where a person is a resident. Now, what could be some of the situations, okay, where an entity may be considered as not be liable to tax? Meaning thereby, if it is not liable to tax, it is not a resident. If it is not a resident, it cannot claim the benefit under the treaty. So there could be some examples where a company may not be liable to tax. Not all the ones that we are going to see under these bullets are the ones where a company is considered, or let's say for example a person is considered as not liable to tax, but some of them do have those situations. If a company is totally exempted from tax for all sources of income, then it can be considered as not liable to tax. How about a company which is exempted from tax for certain sources of income while being taxed for the others? So let's say if a company gets capital gains, it gets dividend, and it gets interest. What if it is not taxable for interest, dividend, but it is taxable for capital gains and interest? In these cases also we say that the entity is liable to tax. It continues to be liable to tax even if a particular source is not taxable. The loss-making entities, doesn't make a difference whether you make a loss or a profit. You have to see whether you fall under category A, which is this, or category B. If you are generally liable to tax, just because you made loss in a particular year is not going to make you ineligible to claim the treaty benefit. And what if a person is not taxable for tax laws? Now we are going to see a few more slides on this aspect, but just to explain this point for the purpose of our discussion right now, what can happen is that certain countries may exempt certain category of assessee or taxpayer from taxation. So let's say, for example, individuals earlier were not liable to tax in some of the country in the Gulf. Partnership firms in many countries may be treated as fiscally transparent, meaning that the partnership firm as an entity does not pay tax, but the partners pay taxes on the profits which they get from the partnership firm. And there could be several other cases like this. So how would the taxation work in those cases is something which we are going to see now in the next few slides. Now, in the case of individual, there was a controversy in terms of what does liability to tax means, right? Does this mean that one has to actually pay tax, right? Or does this mean that if a person is liable to tax, maybe today or in future, right? In that case, they should be considered as liable to tax. On this, the judiciary has been divided in India. There are certain rulings which are favorable, where they said that there is no requirement of actually being subject to tax in UAE. This is in the context of India-UAE Treaty, right? The pre-amended India-UAE Treaty, if I may say it. And this was in the case of M.A. Rafiq. But then there was an unfavorable ruling in the case of Cyril Eugene Pereira, where it was held that unless there is a statutory liability to pay taxes, a person is not a resident. So what happens is, okay, let me explain this point a little bit. In UAE, insofar as individuals are concerned, they are not considered as a taxable unit under the UAE decree, right? Since they were not considered as taxable, they were not being paying any taxes. In this context, this ruling was given where they said that there is no requirement of actually being subjected to tax. As long as you are liable to tax, maybe today or in future, you will be entitled to the benefit of the India-UAE Treaty. But then there was this unfavorable ruling that unless there is a statutory liability to pay taxes, just because of the fact that you are considered as individuals which are not taxable, there is no statutory liability on you to pay taxes. If there is no statutory liability to pay taxes, then you cannot be considered as liable to tax in UAE and therefore not entitled to the benefit of the India-UAE Treaty. But the Supreme Court, again in the same case of Azadi Bachao, was not persuaded by the ruling of Cyril Eugene Pereira, right? Having said it, there was a later ruling of the Authority for Advanced Ruling in the case of Abdul Razak, which said that non-taxable entities in UAE are not eligible for tax benefits of the India-UAE Treaty. Considering this, the treaty was amended, right? And now the way the treaty stands today is, it says that for the purpose of this agreement, which is the India-UAE Treaty, resident of a contracting state means and in case of UAE, which means an individual who is in UAE will be considered a resident of UAE if he is an individual who is present in UAE for a period or periods totaling in aggregate at least 183 days in the calendar year concerned, and a company which is incorporated in the UAE and which is managed and controlled wholly in UAE. So instead of the criteria where a person was liable to tax, the criteria is now changed to the number of days for which an individual is present. Now he may or may not be liable to tax in UAE, but as long as he is present there for more than, or actually at least 183 days in the calendar year, he is considered as a resident and therefore entitled to the benefit of the India-UAE Treaty. Now let's look at the case of a partnership firm. If you recall, in India, a partnership firm is considered as a taxable unit, which means that if a partnership firm earns some income, they have to pay tax on that. And the distribution by the partnership firm to the partners is considered as exempt from tax, right? Now suppose, think of a situation where an Indian company pays some form of income to a partnership firm, and there are certain partners in that. The issue which comes up is the partnership entitled to the benefit of the treaty? It is entitled only when it is liable to tax, right? But there could be two situations for taxation of partnership firm. When we look at the tax rules of the country of residence, a partnership firm may be considered as fiscally transparent. Now what this means is, suppose $100 were paid by the Indian company to the partnership firm, this is not going to be taxed in the hands of partnership firm. Instead of this, it is going to be seen who are the partners. Suppose there are two partners, A and B, and they share the profits and losses equally. So A gets $50, B gets $50. The taxation in the country of residence is in the hands of the partners. The firm is treated as fiscally transparent. In such a case, it is not liable to tax in the country of residence, and therefore it is not entitled to the benefit of the treaty. But the partners, which is A and B, because they are liable to tax in the country of residence, will be able to claim the benefit of the treaty vis-a-vis their facts on the respective $50 of income that they get. However, if this firm was not treated as fiscally transparent, meaning that this $100 was taxed in the hands of the partnership firm as their income, right? In that case, it is entitled to the benefit of the tax treaty. In addition to this, there could be certain pension funds, charitable trusts, etc., which are liable to tax in the country of residence if they do not satisfy certain condition for exemption. So just like in India, the charitable trusts, etc., they are exempt from tax provided they operate in certain specific area and satisfy some condition. If they do not satisfy those conditions, they are liable to tax. Similarly, you need to see whether in the state of residence of these foreign charitable trusts or pension fund, how does the taxation work for them? If they satisfy the condition of exemption and they are exempt from tax, but if they do not satisfy the condition of exemption, they are taxed at full rate. In such a case, they are generally considered as liable to tax, which means they are considered as a resident and therefore entitled to the benefit of the treaty. But many countries do not agree to this viewpoint. They may actually say that if they are exempt from tax, the conditions are such that will be always met. They may actually not give them this benefit. Now coming to certain exclusions, which means certain people who are not considered as liable to tax and therefore are not entitled to the benefit of the treaty. That is, people who are taxable, person who is taxable only for income from sources in or capital situated in that state. So if you are taxable only for sourced income, then you are not considered a resident of that state. So let's say if there is a US person who wants to invest into India, right? He wants to claim the benefit of India-US treaty, but insofar as US is concerned, he is taxable only for income from sources which are situated in US or capital situated in the US. In that case, he is not going to be considered as a resident of US and therefore will not be entitled to the benefit of the India-USA treaty. Foreign companies which are not taxed on foreign income, they are generally not considered as residents of those states. So let's say again, if there's a foreign company which is UK based, they derive some income from US, right? And they are not taxed in US on their foreign income, then for India-US treaty purposes, they will not be considered as a resident. Person who under treaty are resident of a third state, right? Obviously, they will not be considered as resident. And in case of people who migrate tax residency, the benefit of earlier residency will be given until the date of migration. Let me just explain this here. So suppose in UK there is Mr. X. He was a tax resident until 31/3/2016. Then he migrated to US and became a tax resident of US. He will get the benefit of India-UK treaty for incomes which are there up to 31/3/2016, and then thereafter it will be considered under the India-US treaty.